Good morning and welcome to the NIGHTCAP PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Sarah Willingham, CEO. Good morning.
Good morning. I wish I could see everybody. It's always really difficult when you can't actually see all the faces. Thank you very much for joining us for our interim results presentation, just to bring you up to date with where we are in NIGHTCAP. Shall we start the presentation? Please feel free, as we just heard, to just type in any questions as we go along, and we will, as we always do, try and do our best to get to any of them, or we, of course, may end up answering some of them as we go along. So this is a slide that you're all very familiar with. Nothing has changed. Our mission is still to build the UK's leading bar group. And we're doing that by acquiring drinks-led hospitality businesses. We've done 5 now in 3 years, and we buy businesses that we believe have got significant potential for creating additional value by putting them into a group structure that can be rolled out across the UK, which we've done very successfully so far. We'll talk a little bit more about that as we talk about some of our cluster models in Birmingham and Bristol that have proven to be very, very successful. And also through efficiency savings, which certainly in the next year we will really start to see coming through the P&L, as we've spent a lot of time and effort integrating these businesses so that we now operate in a really good group structure. So the team, you're all, I'm sure most of you are very familiar already with myself and Michael. I've been in hospitality since the age of 11. I've actually not had a day I've not somehow been in hospitality. I guess the thing I was probably most known for was I had the largest chain of Indian restaurants in the UK, the Bombay Bicycle Club. And I was the director of the AIM-listed group, Clapham House Group. I'm also chair of a couple of other hospitality businesses and co-founder of the London Cocktail Club, amongst a number of other investments that I've done over the years. I'll let Richard and Michael introduce themselves, and then I'll come back and talk a little bit about our board, who you are already familiar with as well. But yes, I'd like to introduce Richard, who is our interim CFO.
Great, thanks Sarah, and good morning everyone. So I'm Richard, I'm the interim CFO, and I joined NIGHTCAP back in December last year. So my career includes lots of multi-site retail and leisure at Tesco and William Hill, and spans other highly acquisitive companies such as Future PLC and Euromoney PLC. And then I spent the early part of my career, so I'm a chartered accountant, spent the early part of my career at KPMG in London. Michael?
Yeah, and I'm Michael Toxford, and co-founder also of NIGHTCAP with Sarah. My career has really been mostly about capital markets, buying and building Neutral, for example, which Sarah and I actually founded back in 2005, where we made 7 acquisitions and sold the business on after 3 years. And that is my role in NIGHTCAP as well, is the buy and build piece, and to help get the structuring right so that we can continue our momentum as we move through.
Our board hasn't changed since last time we sat down in front of you. We still have Gareth Edwards, who's our incredible chair, and 3 very, very good non-exec directors. Toby Vandermeer, who's the CEO of Hastings, Han Yelf, who is a senior corporate lawyer, and Lance Moyer, who is ex-chair of a number of hospitality businesses and also is currently chair of Thatcher's and has worked in a number of PLCs before. So the headlines of our interim results. So we have made 5 acquisitions and made 13 openings over the last 3 years, which is an incredible achievement. And I'm very proud of being able to increase our revenue by 42.1%, mainly driven through acquisitions and also through the increase in the maturity profile of the sites that we've opened since acquiring, so the sites that we opened last year. We have increased our EBITDA by 5% for the half year during a very tough period for the hospitality industry. And we are set to continue to build this great business. We set it up off the back of COVID, and the economy has moved through several additional challenges since we set it up, but we were always a counter-cyclical play. So the acquisition of Piano Works in February 2024 secured the strong trading for our Covent Garden site. They were a sort of pop-up really over the Christmas period and significantly increased our sales in that site, thus leading to an acquisition. It was almost a try before you buy acquisition, which proved to be very, very successful. And we now have their Farringdon site together, turnover over £10 million over the course on a run rate. We do remain cautious about our near-term future trading. There are challenges that continue to be thrown at us, train strikes, which we've talked about every single time. And Richard will add a little bit more meat on that as we go through the presentation as to what the real cost of the train strikes have been, but also, of course, the cost of living crisis. This year has been very much focused on, this half year that we're talking about, being very much focused on the integration of the Dirty Martini acquisition and building an exceptional team. So when you buy 5 businesses, as we have in a short period of time, you get lots of head offices, you get lots of heads of marketing, lots of heads of finance, lots of generalists that operate very, very well within a smaller business. These are people who are fantastic at startups, but we're now at a much bigger run rate. These are people who might run a business that might turn over 5 or 10 million. But if you want those same people to be able to grow and have a business that turns over 200 million, it's a very, very different skill set. So the main focus of this year has absolutely been in the integration of these businesses into a group structure, but also making sure that actually the team around me and then further down the business has been the right team, and that we have succeeded in doing. And again, I'll talk a little bit more about what that really means for the business, and now our ability to very, very easily bolt on large groups of bars into our structure. So we continue to focus on quality, innovation, training, and of course profit in the short term, which you will start to see the integration of these businesses come through, and the synergies. Next, I think. So the consolidation and integration. So after 5 years, 5 acquisitions and 13 openings in 3 years, Dirty Martini was probably our most significant acquisition, actually. We bought this business without a head office at the beginning of the financial year, so the beginning of H1. What was needed was us really getting underneath the skin of this business, and that involved us getting to the bottom of how it all operated, how each of those sites operated, and making sure that they were well integrated into the NIGHTCAP culture and the way of doing things. It was a very, very successful implementation from a cultural perspective, but it did take us a few months. I would say it was September time until we really started to get underneath the P&L and to see that actually the way that they purchased, the way that their menu worked, meant that their cost of sales was much higher, and also the way that they staffed their sites meant that their labour cost was much higher. But we quickly got underneath the skin of that, and by November we had put them all onto our contracts. We had changed the menu so that it was a much more efficient, better operated menu. And we saw very, very quickly those cost of sales come down and back in line with the rest of the business. Likewise, we changed the way that we rotated in that business, and again saw the labour costs come back in line with the rest of our business. And now we see as a run rate, their P&L looks very, very similar to ours. But without a doubt, those first few months, there are some non-recurring exceptional costs that come through the P&L in those. As I've talked about, there was an overhaul of leadership in the management structure, and also digital initiatives. I'm going to come on to that as well, with the successful hire of our incredible sales and marketing director. We waited nearly 9 months to get her into the business, but very much worth the wait. And a lot of the initiatives that she's put into the business are already starting to show their benefits. And we will see a lot more of that over the next few months. But yes, we very much feel that the position that we're in today, we are better operated with a higher quality product and a better trained team than we have ever had. We're now structurally, I think I talked last time about the fact it's almost like we've kind of built the house without the infrastructure underneath, having done all of these acquisitions very quickly. We've now built the infrastructure. We now have a very solid base at the bottom of the business, and we're absolutely ready for the economy to turn, for optimism to come back, and ready to come back into growth, and could, as I said, quite easily bolt on another group of bars if we needed to. Next.
Yeah, so just to touch on the acquisition of Piano Works, Sarah mentioned it earlier, which we completed in February this year. So as Sarah said, it started out with a collaboration we had in our Barrio Covent Garden site, one of the bars that we had opened ourselves organically. They were closing a site they already had at the time in Soho, and needed to fulfill a lot of bookings, a lot of Christmas bookings. So we entered into a collaboration to see how well that concept could work in that site. And we had an incredible Christmas together in that site with them, with nearly a doubling of turnover over the period compared to what we had expected. So, Piano Works is a different kind of concept that adds something new to our group. It's a live music concept where people pre-book, come for dinner, and then enjoy a late night sing-along effectively. And what it does is that it creates a different way of driving traffic and driving people in our pre-sales, because it's events-based. And it does mean that they have the ability to fill bigger size venues than compared to just the traditional late night drinking bars. And we're seeing it consistently now, both in that site from the beginning of this year post transaction, but also we've added their original Farringdon site to the mix as part of the pre-pack acquisition we made in February, which was, I think the total overall consideration was about £200,000. So we've added a significant amount of revenue and revenue uplift as part of that transaction, as well as giving us the opportunity to do more with that concept in sites that we wouldn't necessarily operate under some of our other brands. So that's really exciting for us. This is just a little recap for those of you who've not followed our story from the beginning. We are only 3 years in, 3 years and a bit in, and since our IPO. And the IPO fundamentally was all about the principle that we saw an industry that was heavily indebted post-COVID, and it was in need of equity injection into the sector as a whole, and with that also consolidation. We thought that would be a relatively short-lived period, but as Sarah said, we are still seeing it, and in fact, the consolidation is accelerating in the sector, which we will come back to slightly later. So we've bought 5 companies, and we've also organically rolled out 13 new sites across the key brands that we've got. And have positioned the group now with 46 sites really, really well for future organic growth. The businesses we've been focusing on have been very specific around flexible, themed late night bars that are often smaller and sort of a move away from this sort of sticky dance floor nightclubs of the past. And this is most definitely the direction in which the whole market is moving. And again, we'll talk to that in just a bit. In fact, now, so the first point around the changing landscape, we saw this pre-COVID actually, that nightclubs were closing, and particularly the bigger sites. And we've seen that continue, particularly with Recom UK's restructure that took place in the last couple of months, where they've closed more than half of their estate. They're left with 24 sites in the UK, and their main focus is on late night bars. They have pretty much shut the whole part of the business that was focusing on the sort of old nightclubs, really, really large venues with cheap drinks. And I think what we've seen with Revolution Bars Group, with the announcement also this morning, there's a question in the couple of questions actually on that also in our Q&A already, that we're seeing that they are also in the last year, 18 months, they've been shutting some of their older, very large, generic part of their estate, and have a focus on their Rev to Cuba brand, which is sort of their smaller, more themed estate of late night bars. So that is very much where the industry is moving, and the consolidation, we think 2024 in particular looks to be the year where significant consolidation will happen, not just in these two instances, but it is happening across the industry. We're seeing a lot of strategic rethinking, and I think NIGHTCAP, whilst and Sarah's talked to this, NIGHTCAP, we've built a strong portfolio of 46 bars that are sitting smack bang in the middle of where the market is moving to and has been moving to for a while. But and we have lots to do in focusing on optimizing that estate, as Sarah is talking to. But at the same time, we are also very conscious that we were and have been created, it's in our DNA to be part of leading the consolidation efforts with the very strong team we've assembled. So we will keep a close eye on all of these developments and be part of them where we find that it is relevant and creates long-term shareholder value, which is what it is all about, of course.
Yeah, so I have talked about this a little bit more, but I really can't stress enough the importance of this structural change within the business when you're a highly acquisitive business and also organically rolling out, and you've got ambitions to grow so much bigger. You've got to make sure that you have the right foundations in place and the right people around you to be able to lead the changes in each of the sort of departmental specialisms that come with running a much larger business. So we now have a fantastic group people director, and he's been in place now for 1 year. And if I think about the changes that have just been made in that year, our retention across the business is up significantly, and it actually saves us hundreds of thousands of pounds in terms of recruitment. We've gone from having 150 odd open jobs at any one time now down to a much, much bigger business and only having 41 open jobs at the moment. So the amount when we managed to retain people, so we've cut back on the churn by 25% within the group. So the impact that it has, not just on the culture of the business, on being able to train great people to make great progression through the business. When you're growing rapidly, you need succession within the business, but also the really positive impact that we'll really start to see coming through on the P&L of a lot of our people initiatives makes a huge difference. The group sales and marketing director, as I said earlier, we waited nearly 9 months for, but we finally got her into the business. She came in just before Christmas and has made some really significant changes. I'll talk about that a little bit more detail on the next slide, because I think it warrants actually its own discussion point, because it's so significant, the impact. But yeah, to get that team, and of course we have Richard here, our interim CFO, who's doing a fantastic job in really sorting out all of the structure. You imagine you buy 5 businesses, it's 5 different till systems, 5 different charts of account, 5 different payroll systems, 5 different contracts. I mean, everything's completely different when you buy it. So now we have the ability to be able to make those changes very, very quickly, because the foundation is laid. And we are ready for that significant growth now. So I feel very, very confident of our ability to be able to grow at any pace, actually, with this team in place. Digital first, this warrants its own slide, because it's such an important area of growth for us at NIGHTCAP. We didn't just inherit 5 different contracts of employment and 5 different charts of account. We also inherited 5 different websites, 5 completely different ways of doing things from a marketing perspective. So we now have an expert team in place. We have an amazing digital person. We have an amazing marketeer. We have a fantastic sales and marketing director. So just if I look, something really fundamental, which is just our websites, our conversion historically has been significantly under 4% across those websites, which is actually very low for what it should be. But that's because we had old legacy websites that didn't work particularly well. Just the overhaul of those websites will bring that conversion rate in well above 5%. That in itself, when you consider half of our revenue is through pre-booked sales, 30 plus million, will have a really big impact. We've put in a new CRM system. We can actually talk to our customers, follow them, we can email them, we can get into their inbox. Sounds like a really basic thing, but when you buy 5 small businesses, it's not a given. So all of these things that are really significant changes will have a really big impact. We have not had auto-confirmed bookings or live bookings across any of the platforms, across any of the groups. We will have all of our estate will be live with live bookings within the next 4 to 6 weeks. At the moment we have auto-confirmed bookings are like 20% of our bookings. So imagine the manpower that it takes to get people over the line and confirm those bookings. A comparable business similar to ours would expect to do 80%. So just from that ability for a customer on a Saturday night to be able to go in and go, yes, I want to go to Blame Gloria Covent Garden on the website and book like that and get it confirmed is going to make an enormous difference. So a lot of these changes that Michelle has brought in sales and marketing that will all started to come live, but will all be live during the rest of this financial year. Again, are going to have a really big impact by us actually changing nothing, just changing the underlying system in next year. So I'm very, very excited about that. We'll also be able to cross-sell between the different brands, which again, when we've got a cluster that does nearly 8 million turnover in Bristol, we've got all of 5 bars within walking distance of each other. Again, amazing opportunity to be able to cross-sell and communicate to our customers. If you go to Blame Gloria, we can offer you Corn Streets. It's got a later license or et cetera, et cetera. So yeah, very, very excited about this.
Great. Turning to the numbers then. So we had an incredibly strong period of trade over the all-important Christmas time, with revenues up 65.7% to 7.5 million and up 11.9% on a like-for-like basis. In December as a whole, we generated 9.2 million of revenue, up 55.9% on December 2022. And that was the largest monthly revenue in the group's near 3-year history. Quarter 2 showed further very strong growth of 39% in revenues to 18 million, but with like-for-likes declining 5.9%, sorry, which actually was an improvement over quarter 1, where our like-for-likes were minus 16.7%. And bringing that all together, that brings us to record half-year revenue of 33.4%, up 42%, with a minus 10% like-for-like decline. So in summary, the half-year started with some tough conditions, but we improved throughout the period with a very strong Christmas to round off the first half of this financial year. On to the next slide then. So our half 1 revenues and EBITDA have continued to grow over each of the last 3 years. Half 1 revenues have grown at a huge CAGR of 157%, and H1 EBITDA has grown at an impressive CAGR of 63%. And if we hadn't had all the rail strikes in this first half of the year, actually the EBITDA CAGR would have been 82% over that period of time. So this growth, just back one slide.
Oh,
sorry. So this growth is a result really of the execution of our mission to be the UK's leading bar group, from the acquisition of our 5 bar groups over the period of time and the organic rollout of 13 new sites, which has taken the group from 10 sites at launch to 46 sites now. Next slide, Michael. Great. So as mentioned, the first half revenue was 33.4%, up almost 10%, 10 million or 42% on the same period last year. The newly acquired Dirty Martini was the driver of the growth in the first half, with the rest of the estate broadly flat. The rail strikes and the cost of living crisis suppressed our organic and revenues and like-for-likes. But the impressive Christmas trading was boosted by the very successful Pianoworks residency in our Barrio Covent Garden venue, which Michael mentioned earlier. We also, over Christmas, saw a record number of pre-booked covers, up 27% during that Christmas period. So in general, for Christmas, we saw a better performance in the regions as the cost of living crisis and rail strikes seem to have had a greater negative impact in London than outside of London. Gross margins were impacted by the time taken to migrate Dirty Martini onto more favourable NIGHTCAP supplier contracts. The slightly higher mix of food, which obviously generates a lower margin. That's principally, again, from Dirty Martini, which does quite a bit of food, and the Tuttons restaurant in Covent Garden site. And also some price sensitivity in certain locations. On the bottom line, despite the challenges of negative like-for-likes across the 6 months, it was pleasing to grow our adjusted EBITDA by 5%. And if we add back the impact of the rail strikes of 0.8 million, our bottom line growth would have been around 44%, so slightly ahead of our revenue growth percentage. We also absorbed within EBITDA a number of costs from the integration of Dirty Martini of about 600,000, of which 300,000 of that will be non-recurring. The next slide then. Train strikes. Yeah, frankly, we're a bit fed up of talking about the train strikes. They've been going on for coming up to 2 years now, but they don't seem to be going away. In the first half of the year, we had 22 days of strikes, plus 3 weeks of overtime bans, and it's cost us an estimated 0.8 million of EBITDA. And actually, we're still going to face further planned rail strikes and tube strikes and overtime bans in April and May this year. So we've got those to look forward to as well. And it's just really, really frustrating for the hospitality sector, with particularly late night disproportionately hit. We just can't perform at our best until these disputes are solved. With Dirty Martini, so we acquired it without a head office. And as a result, it did take us a little longer than expected to get really good quality information coming out of that business on which to make decisions. So integration costs were higher than we expected in areas like supply chain and labour costs in sites, as well as IT and some other general inefficiencies. But the operations team moved really quickly once they had the information to change rotors, to move on to our NIGHTCAP supplier contracts, and to integrate things such as our marketing activities as well. So fortunately, that did cost us 600,000 of EBITDA, but actually getting onto it quickly meant that it's probably a lower number than it could have been had we not had a really great operations team that jumped on top of that as soon as they could. And I'm pleased to say that today, Dirty Martini is now fully integrated into the rest of NIGHTCAP. So it's on all of our major contracts. It's plugged into our marketing activities. We've got really great rotors running in those sites. Next slide. Great. So I think this is me just recapping. Record H1 revenues, the highest ever for the group of 33 million. Our adjusted EBITDA was up 5% to 2.1 million. And again, it dragged down by those integration costs and Dirty Martini acquisition costs, which won't recur. Actually, our Dirty Martini itself, so it delivered 10.2 million of revenue in the period, which, considering we paid, was it 4.7 million for it, was a pretty good return in the first half. The Piano Works, obviously we had the residents in our Covent Garden Barrios site in the first half, and acquiring the remainder of Piano Works in the second half of the year will only add additional revenue in the second half. Our closing cash at the end of the year was 3.1 million. And as you saw from our trading update recently, we are trading in line with expectations. Sarah.
Thank you very much. I mean, I can't really add much more to that, just to say that it's been it's not been an easy year to integrate all of these businesses, to build the foundations, to put the team together against the headwinds of the cost of living crisis and the rail strikes. But we have managed to do it, and we've managed to do it very well, actually. There are, without a doubt, some of the costs that have gone through the P&L in this financial year are non-recurring and will not be seen again next year, for example, and they are part of that integration and part of buying a business like Dirty Martini of its size without a head office cost, but well worth every penny. Exactly as Richard said, it was a very, very good acquisition for us. Very good acquisition, actually. So yeah, we remain cautious about the macro environment, but we think we have absolutely bottomed out in the late night and the hospitality sector, and that we will now start to see the world come back, actually, as people get a little bit more money in their pocket. Research tells us that the first thing they spend it on is going out, and we've just got to make sure that we are the bars that they go out in. So thank you very much for listening, and we welcome questions.
Sarah, Richard, Michael, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. Can I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Yes. So there was one question around Dirty Martini integration. I think we've answered that, so I'll skip that one. But Richard, perhaps you'll help us with this one. Given Revolution share suspension citing increased costs for minimum wage, I think national living wage, do you have similar pressure at NIGHTCAP?
Yeah, thank you for that question. Yes, we will have similar pressure from the minimum wage increases. It's a 10% increase or more, actually, for those on the moving up the scale. For us, on an annualized basis, it's probably about another 600,000 of cost from moving up to the national minimum wage now. Part of that we'll feel in the second half of this year, so about a quarter's worth, because it's just kicked in now.
There's a couple of things I think to add to that. Firstly, the change in the trunk system that comes in July is a way we're working, looking at what are a lot of other hospitality businesses doing, and working on ways in which we can actually help to mitigate some of that cost, and the through the new trunk system in July. So that's one area that we can definitely look at. And the other way is, when you look at the national insurance has gone from 10 to 8, this increase of nearly £1 actually in our target market's pocket is, we're very much hoping that we will start to see that. And a lot of other people in our sector are talking about it in exactly the same way, that we will start to see that also flood through in their ability to spend on going out. So we are, whilst we've budgeted to expect the hit, exactly as Richard said, we are also mindful of the fact that people will have a few more pounds in their pocket to spend on going out, and that we do have an opportunity to work with the new changes in the trunk system from July onwards.
And thankfully, we have more customers than we have employees, so hopefully, a net positive effect to us. So perhaps, Sarah, you'll continue on this one. Which bars have you closed in the past 12 months, and why?
So we have closed Barrio, Watford. It's quite painful, actually. It's always very, very painful to get one wrong. I remember there's always one you get wrong, at least one you get wrong. Luckily, we only have one. Watford has just completely died. I was talking to somebody the guy who runs Recom last week, actually, about his sites in Watford, and they've had exactly the same. They've had to close all of theirs down. It's just, Watford is just not what it used to be, and there's no doubt if I had my time again, we wouldn't open in Watford. So sadly, we haven't opened there. It lends itself to a much more local offering. I think if a pub group took that site, I think they'd probably do very well out of that, much more food led than we are. But late night, the people from Watford are just coming into London.
I think there's a follow-on question. What are the plans for the site? And I think the answers there, Sarah, is pretty well given. Is that we are looking at ways in which we can offload the site to a more appropriate concept. And that's what we'll continue to do. And there's a follow-on question there. Does the group have any other non-trading sites with liabilities? And the answer to that is no.
No, we don't. In fact, we have very, very, very few sites that to date do not operate profitably. Like, we really, the two big ones were Watford, and also we wanted to make more out of the Barrio Covent Garden site, and now of course that's extremely profitable with piano works in it. We've done a couple of turnaround projects on a couple of the London cocktail clubs that have been very, very successful. Brought those sales have really increased, brought those into really good profitability now. So we're very focused on that we don't carry any loss-making sites.
So then there is a question that goes, this all sounds very lovely, but can you indicate as to why the share price is so poor? And I think, it's a fair question, and one, as large shareholders ourselves, one we ask ourselves. And of course, the answer is multifaceted. Number one, I think AIM all share since Putin invaded Ukraine back in a while back now is down roughly 68%. So I think there's been a general exodus of capital overall, which has damaged a lot of smaller companies like us in terms of liquidity. I think there's definitely been a reluctance to invest in consumer-focused businesses across the board in the UK, and that goes both for online and retail and hospitality. And I think a lot of investors have been looking at, when are we going to hit the bottom in terms of the impact of increased interest rates and the cost of living crisis, and I think we definitely have a firm view, and we feel like we're seeing that in the numbers, that whilst it's been a tough ride, that we've definitely bottomed out in this sector. It's what we're hearing, not just from hospitality or other hospitality businesses, but also from retail, that there is an expectation to perhaps roll along the bottom for a bit, and then as interest rates hopefully come down and the cost of living crisis, or the impact of it with increased wages starts, sort of the pressure goes down, that we'll start to see a more confident consumer, and that will drive the whole sector and will drive our share price. I think the only other thing to say is that when you're a public company and you grow as quickly as we have done, there is a lag. There's firstly a lag in terms of people actually seeing the impact of the acquisitions you've done in terms of the size you're getting to. And then there's a further delay in terms of the ability to convert that revenue into profitability. It's very important to understand the core metrics of the sector we work in are pretty simple, actually. They work on what we call a 2010 basis in terms of long-term potential for a business like ours, is that the long-term average should be that in terms of site EBITDA, we should convert at roughly 20% of revenue, and in terms of EBITDA, we should roughly convert 10%. And we absolutely believe that is the long-term potential of the sector as a whole. And that is why we feel there is such a strong opportunity, both for delivering on what we have, but also in participating in additional consolidation as and when it's relevant. 14 we've answered as well. So there is a question, perhaps, Richard, could you give a bit of detail on how the rail strike EBITDA impact of 0.8 million was determined?
Yeah, thanks for that question. So it's very easy for us to actually identify where the revenue is lost, because we will have budgeted for certain days trade. We would look at like for likes and see what a normal day or evening would be in our particular sites. And then when a train strike happens, whether that's on the 20th of July, for example, or the 1st of September, or whenever it was, we see that revenue just get switched off straight away. So really the difference between what our expectation was on a like for like on that site and what actually delivered, as well as looking at what we forecast for the site, is the way we work out the revenue loss. It's very, very quite easy to spot it straight away. And then we apply a margin to that. Obviously, we would lose, not all of that revenue drops straight through to the bottom line. We wouldn't have the cost of sales associated with it. We would still have a bit of labor, because you can't take there's a minimum number of hours in the site. So basically we've looked at every day, looked at what revenue was lost compared to what we would expect on a like-for-like basis and on our budget, and then applied a margin to that to say that's our lost EBITDA. And we've done that for, I think it's 22 days of strikes plus overtime as well throughout the period.
It's so brutal. The impact is, I can't tell you. You literally look at like the week before. So let's say we were supposed to do 1.2 million. Let's say the week before you do 1.2 million and the week after you do 1.2 million ish. And then that week of the train strikes, you will see on your Saturday night, instead of doing whatever, I'm making these numbers up, but whatever, let's say it's 600 grand, you'll do 350. I mean, it's that brutal. You'll actually see a week before and the week after, exactly as Rick said. And then the train strikes, we can see in our pre-booked sales, which is said earlier, 50% of our revenue. We're actually pretty good at predicting our revenue. You know, a few weeks in advance, we can see it, and we can see that we're not getting the bookings in. We're not selling any of our events. We're not selling any of our brunches. And then you do not, the same ratio applies to your walk-in trade, and you literally see it. 1 week you do this, the week after you do that, and in the middle, you're just down like 250 grand. It's incredible. It's really brutal.
There is an ability to switch. So sometimes pre-bookings, you can then move into a different week, so you may not lose it all. But walk-in trade certainly goes. A lot of the pre-bookings don't want to move because it's a particular event, but it is really harsh. So yeah, hopefully that's added a bit more colour to how we determine that EBITDA.
And they don't even book. That's the point. They go, oh, there's a threat of a train strike, so I'm not even going to book. You know, it's really brutal. I could sit here and talk all day about train strikes. I mean, it's the one thing. It is the one thing that has had by a mile the most significant impact on us since we started NIGHTCAP, by a mile. Yeah,
that is very fair to say. So there is then also a question, and I'll sort of start out trying to answer it. Do you anticipate you will need further funding in the next 12 months, given the share price is at all-time low? Any future equity raise will be seriously detrimental. What alternative financing arrangements do you have? Yeah, there's about two questions to that same effect. I think the first thing to say is that we have, with our main banking facility with HSBC, we have a very strong relationship, and we have an ongoing facility with them that stretches into 2025, and with the option of extending that further as well. We have some convertible loan notes that we took on when we acquired Dirty Martini. We've extended those, so they stretch into 2026. So we have sort of good visibility of our sort of, let's call it core financing. But it is important to note, I guess, that when you look at us IPOing in January, 21, the last time we've actually been to market proper to raise capital for our expansion plans was 4 months later, in May 2021. And since then, the activities that we've undertaken, the acquisitions we've made, we have done by being creative, speaking to the alternative financing arrangements. That's why we've got the loan notes on our balance sheet that may or may not be converted in time. And I think that speaks to the fact that we fully understand that when you are a counter-cyclical business that is focused on acquisitions that have to be earnings accretive in the long term, you will also go through your periods of turmoil. I think we are all surprised at just how complex the landscape has been for hospitality since we IPO'd, but it certainly speaks to our thesis, which is all around the consolidation, with that as a backdrop. So we're going to continue to be creative in terms of how we can consolidate the sector, and of course our share price will at some point start to reflect the underlying business that we are building. We perhaps think it should reflect it slightly better already at this point, but the markets are what the markets are. So I think that's the best way to answer that. We obviously don't know what we don't know in terms of have we hit the bottom of the market. We don't know if the consolidation we are talking about that is taking place in our space, of the reframing of the market as a whole, where that leads our conversations with market participants. But that is what we are here for, and that is what we set out to do. So we will continue on that roadmap. We'll see where that takes us.
I mean, I think one of the things that I always think, certainly when I've invested in companies before, is I've looked at the what is the focus of the management team. And Michael and I founded this business together. We're extremely focused on shareholder value. Very frustrating to see the share price where it is at the moment. And if you look at the AIM market in general, we're pretty much reflective of that actually, and the sentiment around hospitality. But the fact that Michael and I started this business, put a lot of money into it ourselves, the shareholder value remains our utmost priority in this business. And I think certainly I certainly know from having made a number of investments in the past, that's something that I always look at when I look at investing in a business, just how important that is. We will not and cannot take our eye off the most important thing, which is the increase in shareholder value.
Yeah, there's one last question actually, which is whether we know if the hospitality community as a whole is working with government and rail groups to try and mitigate these strikes. It must be having a wider economic impact. And I think, Sarah can talk to this as well, but I would certainly say that a lot of effort is being put in by hospitality groups to try and influence. I think the reality, though, is unfortunately
Michael's focus
again complex because we are in an election. Oh, have I frozen?
You did, but it's complex because it's in an election period. And I think the truth is that there's a limit to how much impact a lot of people can have, but there is a lot of lobbying, a lot. But it's the same, even the changes in the trunk system in July. There's a lot of lobbying on that. Do I think it's the right result? No, I don't. I really don't. I think it should have been done differently, and it should have been done better, and it should have been done by people who really understand how hospitality operates. Likewise with the train strikes, the impact is huge on our industry, and also, exactly as you say, wider economic impact, the impact on retail and other businesses. So I think a lot of very good people are working very, very hard to try and have some kind of impact within government. Are they succeeding? They're definitely doing something. Would we like to see more impact? Of course.
I think that concludes our Q&A. I can't see any more questions we haven't done.
Sarah, Richard, Michael, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to yourselves and the company, Sarah, could I please just ask you for a few closing comments?
Yeah, just to say thank you very much, and thank you for the shareholders that have continued to support us through this and do continue to. And I hope that we have given you enough to continue that support, but also some people that I see, there's quite a few people on this call actually who are not already shareholders. So hope to see a nice movement in the share price later, as you're all encouraged to go and press the buy button.
Sarah, Michael, Richard, thank you for updating investors today.
Thank you.
Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of NIGHTCAP PLC, we'd like to thank you for attending today's presentation, and good morning to you all.